Hey everybody, welcome back to 5 Minute Financial Markets. Well, we bounced around a little bit today and ended up pretty much where we started. Taking a look at the 1 minute chart, we opened a little lower than yesterday's close, right around 379. Chopped around, bounced up to this green line here, 381.04. That was last week's low price, and that served as support and resistance throughout the day today. You see that we just kept coming back to retest that level, bounced very cleanly off it here around 11 a.m. Pacific time, and closed pretty close to where we started. Not a whole lot of interesting things to look at on the 1 minute chart, although I would like to point out, I've talked about a lot of times in the past how when there are days that the S&P makes slightly higher highs throughout the day, just very small incremental higher highs, that it tends to run all the way into the close. And if you can identify that early, you can ride the position all the way to the close. Today was an example of the exact opposite of that. So we opened down early, ran up to what was the high for most of the day, and then just sort of chopped around in between, made a slightly higher high here, but it was the only higher high of the day. And then we just sort of bounced around. These are days that are a lot less predictable. So if you've watched some of my prior videos where I talk about those incremental increases throughout the day and riding it all the way into the close, this is an example of when that doesn't happen. You would not want to take a position hoping to ride it into the close today because we didn't have those 10, 15, 20 slightly incremental higher highs early in the day that showed that the market had momentum to carry that into the close. Let's take a look at the daily chart. Not a whole lot interesting here except for one very interesting thing, which is that we did retest this pink neckline one more time. The second day in a row we've come down, retested this neckline, and rejected off of it. What is this pink neckline? This is going back to the big head and shoulders formation that marked the peak of the market back in January. Here we have the shoulder, the big head, and the second shoulder. And so this neckline marks the bottoms of the two shoulders. And that's a very important line in technical analysis. When you look at a head and shoulders formation, which is usually a very strong indicator of a market reversal, that neckline is a key level. And you can see that throughout the year, that has served as support and resistance every time we've come into contact with it. And the same thing's happening here. This is a slightly bullish sign in the near term. Since we have support here, it does look like we could bounce off and possibly retest this prior 390 support level, which would now serve as resistance. The fact that it's held 2 days in a row is a good sign, but some of our other indicators that we've been looking at have turned from bullish to bearish, such as this smart money, dumb money divergence chart, which we've looked at several times before. I pointed out that we have this divergence forming where we've got a lower low on the S&P, but what had been a higher low on the HYG. Well, today the HYG formed a lower low, eclipsing the low from November 15th. It's just very slightly. We had a low of 73.73 on November 17th, actually. And today we had a low of 73.69. So it's just 4 cents. It may not necessarily be the end of this divergence. If HYG rebounds tomorrow, I think we could still consider this divergence to be intact. And this would be a slightly bullish indicator because it shows that the smart money, the high yield bond market, does not see the same weakness that the S&P does. Again, as I've said before, when you see divergences between the stock market and the bond market, trust the bond market. They're much more informed traders and it's a much smarter market. Quickly want to talk about this headline. This was actually from a few days ago, but I wanted to bring it up because we talked about it in a previous video. Retail sales were extremely disappointing in November, and it's not a surprise. If you look at my video from November 20th, I predicted a very disappointing Black Friday and holiday shopping season because of two main reasons. One, consumer sentiment is the lowest it's been since 1980 and the lowest it's ever been heading into a Black Friday. And two, the personal savings rate is almost the lowest reading on record. 2.3% as of October 2022. The only lower measure we have in 60 plus years of history is July 2005. We were just a couple ticks below that, but this is really negative for the economy, for consumer spending, consumer confidence, especially coming off these COVID highs where we were up at 25-30%. That is a really steep drop in a very short amount of time. I'll link to that November 20th video in the comments if you want to see the whole thing. Finally, I want to take another look at silver. We've been looking at silver almost every day for the last couple of weeks because it's been showing so much strength, just grinding right through this chop area, breaking out of these parallel channels. Today it eclipsed the recent high of 24.39, broke out a little bit higher to 24.49 before coming back to settle about 20 cents below that. But this chart just looks so strong and so bullish. We could definitely still have some more consolidation here, maybe even break back into this channel, retest this shaded area one more time. But I feel very strongly that we're heading to $25 an ounce very soon. That's all I've got for today. As I've said before, these markets are really choppy right now, a lot of uncertainty. Protect your capital, practice good risk management, and be safe out there. Thanks, and we'll see you next time.